Welcome to the CU 2.0 podcast Greatest Hits Edition. This show is from the library. Of course, it's a greatest hit. And on the show today is Keith Leggett. That's a name that used to inspire cursing on the part of usually mild-mannered credit union executives. That's because Leggett was chief economist at the American Bankers Association. And he also wrote Credit Union Watch blog, a blog that just, got credit union people very upset, very angry. Now, this show is worth a listen today, even though it's a few years old, because we talk about bank mergers, also credit union tax exemption. These are two issues that are back in the news again. And Leggett tells us what banker perspective is on this. In the show, we discuss Maine Harvest. That was an innovative credit union that, alas, merged out of existence into 5-county credit union in 2022. Shows that starting a new credit union really is tough. Focus on Leggett's thinking about tax exemption and bank credit union mergers. He makes excellent points.
The CU 2.0 podcast.
When a credit union buys a community bank, is that dancing with the devil? Welcome to the CU 2.0 podcast. This is your host, Robert McGarvey. Today's guest, Keith Leggett. He's now retired chief economist with the American Bankers Association. He still writes his legendary and infamous, or perhaps famous, Credit Union Watch blog. There's a link to it on the page for this podcast. Check it out. Keith has been saying very profound, very interesting and provocative things about credit unions for a long time, and he's still keeping up at it. Topic of the talk today, bank credit union mergers. Some banking experts are up in arms about these mergers. Not Leggett. He says community banks that are up for sale generally are looking for the best valuation for their shareholders, and credit unions in some cases are exactly that, as they seek to add new business capabilities, especially in business lending. And the fast route to that capability is buying the right community bank and retaining key staff. On that note, listen to the CU 2.0 podcast with retired State Employees Credit Union CEO Jim Blaine. Leggett references his ideas in this podcast. We also discuss Maine Harvest, which we also did a podcast with, and Leggett points to research on credit union bank mergers via Philemon, also the St. Louis Fed. Links are in the intro to the podcast online. Numbers to remember, by the way. We might be talking about dancing with the devil, but in the past 2 years, there have been around 400 bank mergers. There have been around 20 bank credit union deals. 20, compared to 400. Meantime, Leggett tempers his positive perspective on bank credit union deals by saying there needs to be a two-way street. That is, the regulator, talking to you, NCUA, needs to lighten up about credit unions selling out to banks. It's an interesting thought to ponder. Is standing in the way of those deals really in the best interest of the members, the member owners? Leggett has some very provocative thoughts on that question. Why do bankers so often loudly scream about bank mergers with credit unions? A lot has to do with association politics, says Leggett, who asks that there's always a stronger response when a wolf is said to be out the door. And it's not just bank associations who like to see wolves at doors. Credit union associations are right there too. It's a good podcast, provocative. Listen.
We're going to talk about credit unions merging with banks, which, as you know better than I, is suddenly in the news, certainly in the banking publications, to some extent in the credit union publications. Is this really the final sign of the devil? That's my question.
I don't see it that way. My view is that banks that are looking to sell are interested in selling to any institution that's going to offer the best value to the shareholders. And I think that what's occurring is that you have had cases where credit unions have provided the better bid than other banks.
That's pretty much how I see it. As I see the numbers, according to NAFQ, there have been something like 400 mergers bank to bank in the last 2 years. And there have been 25 credit union bank mergers. No, not even 25, about 20 in the last 2 years. And that number just is paltry compared to the 400. So I assume the institutions that were acquired by credit unions had kicked the tires with community banks and just, as you said, got a better bid from the credit union.
Right. And what you got to realize is when you look at some of these banks that have been selling, what you have is that investors were looking to cash out on these investments, and the credit union just provided the best deal in these cases. So in that regard, I don't think there's anything wrong with these transactions. My view has always been one is that it should always be a two-way street. Credit unions should be able to acquire banks, or at least their assets and their deposits. They can't acquire the stock. And banks should be able to acquire a credit union. In many ways, when you look at credit union mergers, we're looking at, I guess, been averaging about 200 a year as far as credit unions.
Yeah.
I kind of align with Jim Blaine. Jim Blaine who was the former CEO of State Employees Credit Union. He's been critical of all these credit union to credit union mergers. He doesn't necessarily see them as being beneficial to the members. And he actually said it would be better if the credit union that is a target would voluntarily liquidate, because this would ensure that the members would get access to this accumulated retained earnings, and that would be paid out to them. And that is clearly more beneficial than the merger. I just kind of view it from a different perspective, and that is what should be taking place is that credit unions that are looking to be acquired should be at least going out and soliciting offers from banks. Because what would happen is that in this transaction, the members would gain access to the accumulated retained earnings, and then probably in most cases, the banks would probably pay a little more than par, and so the members would make out in these transactions.
Why isn't that occurring? I know there have been a couple cases where banks have acquired credit unions, but really, I think you can count it on one hand.
Yeah, I think if you look at it, I would put it that NCUA's rules governing credit union bank mergers throws up unnecessary roadblocks with regard to these transactions. And, a lot of it deals with, allowing for member communication with regard to these mergers. You do have, these disclosures that say, oh, you're going to be giving up your ownership rights. Well, you're getting compensated for it. There's requirements that, if I recall, under the rule that the board must go out for at least a 30-day period to solicit comments from the members if they're considering this. There are issues where the credit union would have to either have somebody kind of go in and evaluate what is the credit union worth, or alternatively have to get at least 3 solicitations with regard to the merger. It's just all these kind of additional obstacles that are put in the path.
Right.
What you always worry about is that NCUA will come along after the fact and nullify, as we saw with regard to credit unions trying to convert to a bank.
Mm-hmm.
And the other issue that you run into is that you may have management at the credit union that is not really interested in these kind of mergers, because it might mean that they're going to be out of a job.
Well, that's always the case in just about any merger.
Well, that's true.
One management team survives and the other management team tends to die. In some cases, they die very handsomely with rich going away presents. But
if you look at the one transaction that got approved in Indiana, it was a privately insured credit union that basically was acquired by a bank. It did require a 2-step process in Indiana, where credit union had to initially convert to a mutual savings bank, and then at that moment of conversion, it then got acquired by the bank. Because it was privately insured, it didn't have to follow NCUA's rules and regulations.
Right. An analogous situation is I know of at least one income restricted housing cooperative in New York City that voted to put itself out of business as a housing cooperative so that the owners could then sell the property, which was in the Bowery and had been worth nothing, was suddenly worth a ton of money, and everybody got rich. But it was a two-step process where they had to go out of business as a cooperative first, and then and then what was left standing were the owners who still owned it, and they just sold it and made a ton of money, and everybody celebrated, I think, because they made a ton of money.
I think what you would find is that with regards to these transactions, it'll be lucrative. I think what you will find is that those members that tend to have more business with the credit union would end up making out better with regards to these transactions versus those that really don't have a strong relationship with the credit union.
Now, on the banking side of the fence, in credit union land, when you do a merger count, credit union to credit union merger, X percentage of those mergers are essentially sympathy marriages, where a regulator has come along and begged the larger credit union to take over a failing smaller credit union.
That's true, yes.
Does that same thing happen in the community banking world?
There is some where you have arrangements made where you will, the regulator will try to arrange for the credit, for the bank that is having difficulty arranging a marriage with another bank. But if they can't do that, then ultimately what occurs is that it ends up, the bank will ultimately fail and it'll be placed into receivership with the Federal Deposit Insurance Corporation.
Right.
And I think that what happens is in both cases, both FDIC and also the NCUA would like to see if they can have this taken care of before it becomes, where the institution is liquidated and placed into receivership.
And I think in the credit union world, part of the argument is it's just makes all credit unions look bad when one credit union goes out of business. And I know I've talked with a CEO of a pretty big credit union who off the record admitted to me, I asked him why the heck he merged with a tiny failing credit union. He said it was just was doing the regulator a favor, and he hoped it would come back to his benefit someday.
Yeah. Well, sometimes, you got to be careful about whether or not, taking over somebody will actually come back to benefit you, doing it for a regulator's favor, because sometimes it'll come back and bite you. All you have to do is ask J.P. Morgan with regard to taking over Washington Mutual and Bank of America picking up Countrywide and also Merrill.
Right.
So it's not always a bed of roses.
Now, are you aware of any data? I mean, credit union bank mergers have been occurring for approximately 10 years, 8 to 10 years. And are you aware of any data on the success of these marriages?
Yeah, there's actually two studies. One is by the St. Louis Fed.
Right.
And it's maybe a year old. And there was another one, I believe, in 2018. And I believe it was done by a Michigan State University professor, which looked at, how these credit unions performed after they took over a bank. It may have been a Filene study.
Yeah, I'm familiar with the St. Louis Fed study. I've heard a lot of skepticism that these mergers will work because it's two different cultures that might not fit together very well.
That's a possibility. But, if you look at it, those mergers that have kind of fallen through were, at least one of them I know in Georgia, was that the cultures just didn't mesh between the two, and therefore they never consummated. the marriage.
And usually what a credit union will say is, well, we want the bank because the bank can bring us new types of business. And that's kind of the problem because you've never served that type of business. And why do you think you're going to be prepared to serve that type of business now unless you give the bankers free rein, which doesn't usually happen in a merger?
I think that some of the credit unions that have been doing this have been looking at, as the St. Louis Fed pointed out, it clearly was an expansion in business lending that took place at the credit union. That may have accounted for why they did it. And also the other thing is that they, instead of having to go out and buy talent, they bring the talent in with the merger or the acquisition. You bring in commercial loan officers. So this may reflect credit, that the credit union is beginning to change its business model to where it's going to become more of a commercial lender and get out of the consumer business or reduce its exposure to the consumer business.
I think credit unions are rapidly seeking to modify and extend their business models in most cases. And I think community banks are too. And the way I see the landscape is that both community banks and credit unions suffer from the same competitive problem. And that competitive problem is the tenors of really big banks that seem to get bigger and bigger and bigger. Whereas community banks and credit unions are both dwindling in number. I know the assets are up, but the numbers are way down.
Right. Well, I think economies of scale is also an issue where you're trying to bulk up. And also that may explain why credit unions are more interested, or at least the larger credit unions are targeting banks, is that it's easier to bulk up with the bank acquisition to get that economies of scale. It's especially, if you're nearing or above the $10 billion threshold, because that's a new reality for credit unions when they hit that. And they aren't really prepared for the shock of having another set of examinations, which comes from the Consumer Financial Protection Bureau, and also with the fact that you have a diminishment in a source of revenue coming from interchange fees.
Mm-hmm.
And one of the big problems you run into is that there are more community banks in the $100 to $500 million asset size threshold than there are credit unions. And therefore, I think it's easier to pull off this type of transaction with the bank. The other thing that I've heard from experts is that bankers approach this as a transaction deal, while their credit unions who are the target, they have a lot of vested interests in the credit union, and so therefore they're emotionally attached to it, and therefore it's harder for them to make this deal.
Bankers have been complaining recently about the fact that credit unions don't pay taxes. Is that an important consideration, or is that just a useful flag to wave?
Well, I think what we have to understand is that there is a tax associated with this transaction for state chartered credit unions. And basically, I think it's Section 357 of the Internal Revenue Code. And what it basically does is it requires that when a tax-exempt organization acquires a taxable entity, they have to pay taxes on the built-in gain associated with that entity. So it was a one-time tax, and it's basically paid at the corporate income tax rate.
Mm-hmm. Mm-hmm. What about ongoing income taxes? And I ask because I've talked to people, tax accountant types, who tell me that most credit unions could do their books in such a way that they legitimately would not pay any income tax at all. There'd be a handful that would, most of them wouldn't have to pay tax because they would arrange their books in such a way that they didn't owe any money. As I said, that's way out of my expertise, but I've heard that from several sources.
Well, I think what it would, if you were taxed, there are ways to engage in tax avoidance strategies. One thing that you would probably see is that if credit unions were taxed, they would be more likely to invest in municipal securities, which would reduce their tax liabilities.
They could invest also more in technology. If I want to pay less tax in a given year, I buy a new computer in the end of December. And
there are other ways of doing that.
And a credit union could do it on a much larger scale than one new computer. But I read the same thing over and over again from banking executives saying, this is a loss of tax revenue, blah, blah, blah. And I guess I just don't see that as a big issue.
Well, I think what occurs is that this is once you get into what are the policy ramifications of this. And the policy ramifications is that you do have a tax-exempt entity acquiring a taxable entity. There is a reduction in tax payments, but it's not that big. I agree with you. It's not that big of an amount. But also the other issue is that banks are subject to CRA or the Community Reinvestment Act, while credit unions are not. And so these are the two kind of policy issues that take place. On top of that, when you look at it, the issue of the credit union tax exemption is really defined so that they are serving their members, and especially those who are of modest means. One of the key issues that runs into this is that you got basically a taxpayer subsidy that is now going to shareholders of banks. And there is the view that maybe the credit union tax exemption is being used to make the transaction more appealing to the bank shareholders. You're paying more for it. Mm-hmm. And they're able to do that because they don't pay taxes.
Mm-hmm. So this issue, I think we're in agreement that a lot of this seems overblown. And you started out, and I agree 100%, that the banks that sell the credit unions are doing this to benefit their shareholders, their owners. They're not doing it just to be nice to credit union. No community banker wakes up in the morning and says, geez, I'm going to do credit union a favor. I'm going to sell out to them. I don't think it happens that way.
Right. I agree.
And so I'm puzzled by why bankers act as though this is such a bad thing, since it's their own folks doing this, if you will.
I think it's more associated with trade association politics.
That's perfect, because I see this as so much the trade associations, and I know much better on the credit union side. Part of how they do business is by spreading fear among the members. The more fear I can spread, man, the more checks are going to come in for renewal.
Well, you always are going to get a stronger response from people if there's a wolf at the door.
Right.
Now, the same thing if you have to remember is that you saw the same kind of reaction from the credit union trades when we had basically a series of credit union conversions to banks. They all went apoplectic about that.
Right.
Even though the members had voted in favor of it.
And even though it was just a few cases, it really was, this was not an epidemic.
Yeah, I think what is it, about 32 or 33 total or something in that neighbor?
It's nominal, yeah. And each case that I remember looking at was a pretty special case. This was not a widely replicatable situation. This was not going to be like coronavirus. It wasn't going to consume the world overnight.
No, that is correct.
And but yeah, the wolf at the door syndrome is great for credit union membership renewal drives. Think you don't need us? Well, yes, you do, because there's this wolf at the door. So,
Yeah.
so I agree that that's probably one of the biggest drivers of the stuff I see on both sides. Because a lot of this, I think, comes down to, in many cases, these mergers on either side of the fence could be good if it maintains a level of service in communities that big banks don't seem to have a heck of a lot of interest in. And a lot of
I agree.
America are places that big banks don't have a heck of a lot of interest in.
I agree with you. I do know of like one banker who took over a credit union in Nebraska, and basically no credit union was interested in taking over that credit union because they made as a condition they needed to keep that branch in that community. That one, they had a single office, and the credit unions didn't want that. So they went to the banker, and the banker said, "Sure, I'll keep your office open." And that basically, so he did the deal.
I remember talking with a small town politician who told me you can tell when a town's dying when there's no grocery store, there's no gas station, there's no bank or credit union. And
right, yes.
You're missing several of those things. This town is on its last legs. When you're missing all three, it's dead.
Yes, I agree, 100%.
And he was not making a distinction between banks and credit unions. He saw them as interchangeable, which for a small town, I'd say is probably pretty much true. Community banks and credit unions, to me, have a lot more in common than they have apart. Although it's kind of this Hatfield-McCoy thing, which I imagine is more fed by the trade associations than it is by the executives in the community banks and the credit unions.
I will say that there are bankers who do get concerned, but it tends to be on what is the level of local competition with the credit union. If there isn't a lot of competition, you find that bankers aren't really as bothered by credit unions. But if there is some very strong local competition from a large credit union, then it does unnerve them.
I certainly, who does USAA lose sleep over? It's probably Navy, possibly PenFed. It's almost certainly not any small credit union. It's almost certainly not any small community banks either.
Yeah.
And I've asked many credit union executives who their competition is off the record, and almost invariably, all they name is big banks and other credit unions in the community.
Here's the key thing with big banks is that they have the ability to leverage technology and also their scale to aggressively compete in markets if they want to get into a market. And right now, and I don't think credit unions pay enough attention to this, the Federal Reserve several years ago put in this liquidity coverage ratio for the big banks, which basically said that the large banks, when they funded themselves with wholesale funding, it would be penalized. So therefore, put a greater incentive on retail deposits, which tend to be more sticky. So what has taken place is that the large banks are now more aggressively going after retail deposits. And they may not necessarily offer the best pricing, but they have the other goodies, especially in the area of technology, that will allow them to get the customer. And right now, if you go and look at it, you're seeing that in the indirect lending area, Callahan's been talking about how credit unions have seen a fall off in indirect lending in autos. The reason why is they're not offering the best pricing relative to the large banks who are out there competing that market, especially for prime and prime plus customers.
Do you see the numbers of both credit unions and community banks continuing to shrink? And the shrinkage has been enormous in the last 20 years.
Yeah, I think that we're going to watch a steady decline. One of the big issues you have is that there's been really a dearth of de novo banks and credit unions. So a lot of it dealt with the financial crisis and the recession that followed. Regulators just were averse to chartering new banks or new credit unions. We're seeing a little bit of pickup in the case of banks. Credit unions, it still remains, the stream of new credit unions being chartered remains fairly anemic. And the other thing that I think, reason why NCUA is reluctant to insure these new credit unions is that a lot of them don't have a good track record of surviving. That within several years, these institutions are failing, and NCUA basically arranges a merger.
Right. The number of new credit unions year in, year out is just a handful.
Right. And so therefore what happens is if you have very few credit unions being formed, naturally you're going to see a steady decline. And that's also what's happened with regard to community banks with all these mergers. One of the big issues you'll see is that without that new stream of banks coming in or new stream of credit unions, you're just going to see a steady decline in the number of institutions.
And the one new credit union that I wrote about for several years before it was chartered, and finally it was chartered, is Maine Harvest, which is a farmer-only credit union. It's a very unique business plan. They were supported by essentially every credit union in the state of Maine, along with the Maine League, which is going to provide their back office operation. So they were, to me, there was no way you couldn't charter them. They were just so perfectly configured, and eventually they were chartered. But if you just
you have to remember that went through a long process.
Oh yeah, years
before it got chartered. Yes.
How those guys had the persistence to hang in there, I have no idea. They were very, very persistent guys. And what's the payoff? I mean, geez, it's kind of like you suffered, you waited, you persevered for year after year, and now what? At least if it's a tech startup or something, you can say, well, yeah, we'll become millionaires or billionaires, if the case may be now. It's not going to happen in credit union land. So it's you have to be motivated by the mission and the cause, which they were in Maine.
Right. But you look at, for example, you had the attempted formation of that credit union that would serve St. Paul in a minority neighborhood. Yeah. So what occurred is that right now they had to go back to the drawing board, and they lost the support from the city, which was going to extend a interest-free loan to them. And so, so they're kind of starting from scratch in forming that credit union. So once again, this just talks about how difficult it is to charter a new credit union.
Right.
The big difference between banks and the credit unions is that when a bank gets chartered, what's occurring is that they're you have to have investors who are going to put up substantial amount of capital. So they do have capital being put in place. The credit unions need to have commitments from community groups and others that will support the institution. They don't have that capital.
Right.
Or net worth is the appropriate word for credit union world.
Well, I personally think a business where you're not getting new entrants, and in the credit union world, they're not, for all practical purposes, that's a sign that the business has some serious problems in my mind.
The other thing you have to realize is when you look at the credit union industry, about half of the credit unions in the country are not growing, at least with regard to membership. They're actually seeing their membership decline. Eventually,
they're seeing stagnation in assets too, even though the trades talk about the growth in assets. Yeah, Navy Federal is growing like Topsy. But what about the $50 million credit union in Alabama? It ain't growing like Topsy. It's struggling to survive. So,
and I just remember there was a CFO of one of the airlines who said, if you're not growing, you're dying.
Yep.
And I think that's what's happening. You have a number of credit unions that are just slowly withering away.
But to mention a name that you mentioned some minutes ago, Jim Blaine has told me repeatedly that the face of the credit union movement, and he uses the word movement, is the small credit union that's serving a small community. Jim said to me, I go to Washington, D.C., I'm just another businessman to those people. In his case, an influential businessman in North Carolina, but just another businessman, whereas a $50 million credit union CEO comes in and goes to the representative who represents that community. He's got to treat the credit union guy with respect, apparently, according to Jim.
That's the case, and same with community banks. They have a very strong voice on Capitol Hill.
Whereas your senator, you just love to ask nasty questions of Jamie Dillon. Man, that's going to get you on CNBC. But you're not going to ask nasty questions of the little credit union guy or the little community banker guy.
No, you ask the nasty questions of the regulators.
Well, I would love to ask nasty questions of the regulators. I don't know that they want to talk to me, but I'd love to ask those nasty questions.
Before we go, think hard about how you can help support this podcast so we can do more interviews with more thoughtful leaders in the credit union world. What we're trying to figure out here in these podcasts is what's next for credit unions. What can they do to really, really, really make a difference in the financial scene? Can't all be mega banks, can it? It's my hope it won't all be mega banks. It'll always be a place for credit unions. That's what we're discussing here. So figure out how you can help. Get in touch with me. This is rjmcgarvey@gmail.com. Robert McGarvey, again, that's rjmcgarvey@gmail.com. Get in touch. We'll figure out a way that you can help. We need your support. We want your support. We thank you for your support.
The CU 2.0 podcast.